Uh, in the current environment, if you're looking ahead, 5 years, let's say, I ask, yes is a short answer, but I ask, what asset do you want to own? And if I were giving an asset to my grandchild, would it be gold? Would it be US bonds? Would it be Nvidia? I mean, no, I think gold would be the safest bet. So in the current environment, yeah, I mean, I think the holdings in gold should be higher.
Do you see the dollar weakening in the months and years ahead? And if you do, what do you think is going to be the cause of that?
Yeah, that's a big question. There's a lot there. I mean, first of all, just looking at the last little bit of history, as you say, the dollar's been strong, but gold's been strong. Again, just look at who's been buying and why. Mm-hmm. If you're the central bank of Russia and your assets are already been confiscated by the US, you're not going to be buying treasuries. You're going to be buying something and holding it somewhere that the US can't control. And it's insurance. And if you're buying an asset for insurance, you're much less sensitive to price. Mm-hmm. Just as if my home insurance runs out, I don't say, well, I think I'll wait a few months till prices come down. You buy your insurance. Mm-hmm. And so that's why we've seen that disconnect as well between the dollar and gold. Typically, obviously, other things being equal, it's a truism. Other things being equal, when the price of dollar goes down, the dollar price of gold goes up. It should be noted, of course, that in the last couple of years, the price of gold in non-dollar terms in many currencies has actually been at record highs, and certainly is looking much, much stronger in other currencies than gold. And we know why the dollar has been strong and is strong. It's that old, clean the shirt and the dirty laundry hamper syndrome. And I think that's probably going to continue for a little while, but it's probably going to become the differential between the US and other economies in terms of the economy, in terms of the stability of the country, and in terms of the interest rate differentials, which are all three things that led people to the US, I think is going to start moving away. The differential is going to start moving away. In interest rates, when the Fed starts cutting, we'll see that differential move away. The other banks will probably lag the US in coming down. The stability of the US, I mean, who knows what's going to happen between now and November, or between now and the seating of a new president, but the possibility of, one doesn't have to go to extremes, just a possibility of some pretty ugly scenarios in the US is very real. Yeah. And when foreigners look at that, I mean, I don't think Biden's going to be the nominee in November, but they're certainly going to find someone else to run. He's not just going to step down and Kamala Harris become president. If you're sitting in Switzerland, that would not be a good look. Any kind of violence in the streets surrounding the election will not be a good look. And I'll get off that track and back. So anyway, but the things that have led people to the US, I think are going to move away. And again, as we mentioned earlier, when there's a safe haven crisis, Russia's not going to say, oh, well, let's go to the dollar, nor is China. And a lot of investors around the world are going to be less aggressive or a little bit more cautious in putting too much money into places where the US, that the US controls.
Very interesting. Very interesting. I wanted to ask you about the resource sector in general and a bull run. how does a bull run in your analysis in the resource sector usually form and play out? Is it one resource at a time, popping up like popcorn? Do you usually see a rising tide raises all boats for the resources during a bull run? How do you usually see it playing out, and how long do they typically last?
Sure. Well, you can have both scenarios, of course, and more typically, I mean, unless you have specific factors affecting, one resource like lithium and lithium batteries, unless you have something like that, in more niche resources, typically the environment is an environment that is, broadly speaking, positive or negative for all commodities, particularly all resources, not the agriculturals necessarily at the same time. When people talk about a super cycle, which is an extended period when the prices of all resources go up meaningfully, a super cycle is caused when you have a new source of demand. So we saw a super cycle, for example, from 1830 to 1850, when the Industrial Revolution in Britain dramatically increased the demand for commodities across the board. We saw another super cycle in 1880 to 1910, when first Germany and then America industrialized, and the demand for commodities zoomed. We saw another one after the war with Japan, another one in the 60s with the tigers, Korea and Taiwan. And of course, we saw another huge one in the early 2000s with China. And so the commodity boom, which was a super cycle from 2000 to 2010, was driven primarily by the increase in demand from China. And that's a super cycle. So when people say we're entering another super cycle, maybe it's just semantic, but I don't think we're entering a super cycle. Now there's India, there's Brazil, there's Indonesia, right. There's various countries with large populations that are sort of on that cusp. But I don't think that any of those three are about to enter that rapid industrialization phase, which will see that kind of boom in commodities. But and on a shorter term basis, where I am right now, there's several things that can make commodity prices go up in a broad macro sense. The monetary factors, to me, are going to be very, very, very positive. But the global economic outlook, perhaps certainly uncertain. We can say uncertain, right?
Mm-hmm, yeah.
Now, if you have in that environment, gold and silver, the monetary metals, are going to do very, very well. But the other commodities that depend on a stronger economy for demand,
Copper,
maybe they're going to do less well. So I'm much more certain on the monetary metals than I am on the other metals. Now, in this environment, you've got to have demand and supply. Demand and supply, yeah, but the price is going to be determined by demand and supply, obviously. And so you have to look at both sides of that equation. But right now, I am focusing much, much more on commodities where the supply is in question or vulnerable. So a resource, a metal like copper, for example, has a supply picture that I think is incredibly bullish. And so even if you have a weak global economy, not a global depression, but a weaker global economy, and even if you have a slowdown in the rush towards the electrification, because I think everybody knows by now that electrification doesn't really do much for the environment, because the use of metals goes up dramatically. But anyway, that's a different subject. Even if the rush for electrification slows down, and there's signs that's happening, countries putting back their targets for zero emissions because they're simply, like Britain, because they're simply impractical. They simply won't happen. But even if those two things happen, the lack of supply means that the copper price is going to have to move up for supply and demand to match. That's not necessarily true of, say, nickel or iron ore or several other metals.
Yeah, that's a great point. I want to shift over our conversation to the mining companies. A few questions there, but I want to start with oil. In 2022, oil prices went up, and it really impacted the equity values of the mining companies, and it showed how important oil's price is to the profitability, the expense structure. What do you see for oil in 24 and for the mining company expense structures and their profitability?
Yeah, well, I'll answer the second part first, if I may. Yes, you're absolutely right. I mean, energy is the number one cost input for mining. And the second largest cost input is the price of the local currency in which your mine is operating. You're a Canadian company, but your mine is in Australia. What is the Australian dollar doing? Because that affects, all sorts of things from labor, but also to all sorts of purchases, local purchases that you make for the mine. So energy first and commodity currency second. And if you look back to 2011, you see that we are nowhere near where we were back in 2011. 2011-12, oil was at $140 a barrel. We're half of that today, a little over half, but we're half of that today. Look at the commodity currencies. The Canadian dollar, the Australian dollar were both trading at 20-30% premiums back in 2011-12, and they're now at 20-30% discounts. So so despite whatever increases we've seen in the last 6 months or the last year, the cost structure is still, on those two major points, is still very, very favorable, frankly. And I don't think, as a tangent, I don't think gold mining companies are doing any favors to the whole industry by constantly underestimating the general cost inputs from inflation. And, so that every quarterly conference of pretty much every company, the headline is costs going up, instead of looking at where the costs are today with where the costs were back in 2011. Anyway, so what's the outlook for those things? I've been a little bit surprised, I have to say, that the oil price is not higher than it is, especially with everything that's happening in the Middle East. We can look at certain things like China obviously has had low demand for oil and other commodities for most of the last year, or certainly the second half of last year, which is why the copper price was weak, and iron ore prices came down and so on. And that's because the demand from China, which is the largest importer of most of those commodities, including oil and copper, their demand went down. I think there's signs that the Chinese economy has stabilized at a lower level. Number one, inflation in China is beginning to move up, but at the same time, the government in China is increasing its stimulus. We're not going to get aggressive, broad-based stimulus in China, but we're going to get targeted stimulus, targeted on particular sectors and areas that are doing badly. So I think there's reasons for a little bit of optimism about China, particularly as it pertains to their importation of resources. And we're seeing all the indications, I won't go into all the details, but the indications of China's demand for copper, for example, have begun to improve. So if the Chinese economy starts to grow a little bit and the Chinese demand for oil, picks up, that's obviously going to be a positive for oil. At the same time, there's no question that there's a lot of, there's a fair amount, let's say, of excess capacity in many countries around the world. So I'm not looking for the oil price to run away anytime soon. But that's, to get back to your question, that's a positive. That's a positive for the mining companies.
Yeah, that's great. So the mining companies have had long-term underinvestment. The for all the reasons that we spoke about earlier, the issues at the end of the last cycle with their buying spree, the ESG and carbon neutral policies, and the Mag 7 pulling investment dollars over there. Can you speak into the impact that this long-term underinvestment in mining companies can possibly have, both on the companies and on production?
Yeah, no, that's an excellent point. I think your point is less true of the gold companies, more true of the base metal mining companies. We've had significant underinvestment for really 12 years now, for 10 years. And it's an important point because when you look at, base metal projects, they are very long-term projects. So look at copper, for example. It can take from the time that you, not even from the time you make a discovery, but by the time you have a project that you say is ready to go into production, it can be a minimum of 5 years before it actually starts producing. You have to raise $2, $3, $4 billion to put that into production, but they last for 40, 50, 60, 70, in some cases, years. And so the mining companies, they tend to put mines into production. It's much less about the current price and what your forecast for the next 12 months is. That doesn't really factor into the equation. But what's really critical is, as you say, the capital investment cycle. And that's why you sometimes see, you can see a large increase in production when the economy is weak, because it's already been planned. It's already in the works. It's 5 years, and now they've got the permit and they've raised the money and they're building. And who knows what the economy is going to look like in 5 years' time. So when a company pulls a trigger, they're pulling a trigger because they have confidence over the next 20, 30, 40 years, not because they know what's going to happen when the first pour is going to happen. And so the capital investment cycle is so much more critical. So I think that leads to, or suggests, some optimism that over the next several years we're going to see, increased production in many areas. But again, you look at something like copper, and as I say, you have a 5-year minimum from a decision to go ahead to when it starts to produce. And so, as an industry, we have a very good visibility on what future production is going to look like. And the plain fact is that if you look ahead 5 years and you make optimistic assumptions about which mines are going to be in production and which expansions are going to happen and so on, optimistic assumptions, we simply don't have enough copper in 5 years' time to meet the projected demand for copper. And that assumes everything goes well. And as we know from recent events, Codelco, the largest copper mining company in the world, they said they're going to reduce production next year. Rio Tinto reduce their estimate for copper production next year. And things never go as well as you expect. Any surprises in the next 2, 3, 4 years are going to be on the downside, not on the upside. I think we can say with almost certainty that in 5 years' time, there is not going to be a copper mine producing of any significance, but we don't already know is going to be producing. You know, there's not going to be things come out of nowhere. And so with the copper cycle, with the copper in particular, because of the long length of mines, the huge capital, and the long time to get them into production, we can be pretty certain that absent a global recession, you know, the copper price is going to move up.
Yeah. Yeah. I appreciate all of that insight on that. I have one final gold question before we move on. So it's recently been reported that 80% of the people don't own any gold at all, and that institutions and the everyday investor on average hold about 1/2 or less than 1/2 of 1% of their assets in gold, and that the long-term average, 4 or 5 decade average, has been somewhere between 2 and 4%. And so that's a substantial distance. It's also last year in an interview, Ray Dalio had said that he believes that everybody, including institutions, should have a gold overlay on their portfolio of 10 to 15%. That is substantially different than 80% of the population not owning any, and on the average, less than 1/2 of 1%. Do you agree with Ray Dalio on his 10 to 15% gold overlay?
You know, in the current environment, if you're looking ahead, you know, 5 years, let's say, I ask, you know, yes is a short answer, but I ask, what asset do you want to own? You know, and if I were giving an asset to my grandchild, would it be gold? Would it be US bonds? Would it be Nvidia? I mean, no, I think gold would be the safest bet. So in the current environment, yeah, I mean, I think the holdings in gold should be higher. Now, when we talk about holdings in gold, of course, you know, we've got the insurance aspect, and then you've got the investment aspect. So I always think people should have their insurance, their defensive position in gold, and look at that totally separately than they look at the investment aspect.
Yeah,
and that might be 5%. It could be as high as 10%. But yeah, I mean, I think when you put the two together, 10 to 15% is not at all unreasonable.
So moving on to your prospectuses, I was looking through them, and your gold account, the senior producers made up 28%. The royalty companies made up 16%. And so that made a lot of sense there, that the larger companies in the fund, you know, the least risky, made up 44%. There was some silver exposure of 14%. Can you speak on that? Are you liking the silver companies? I know that they don't only produce silver. So yeah, so can you speak on that?
Yeah, well, you've answered the question. First of all, I just need to say what you're looking at are for our separately managed accounts. I just need to make that clear. That is not the same necessarily as the gold fund that we manage, the Euro Pacific Gold Fund. Okay. And we're not allowed to disclose what we're doing other than what's been publicly disclosed, you know, in filings. But yeah, so we have a high weighting, or relatively high weighting, to silver, but as you just said, you know, most of the large silver companies like Pan American Silver or Fortuna Silver produce far more gold than they do silver. And in fact, in both cases of the two companies I just mentioned, the allocation, the production of gold is actually going up in both cases relative to silver. But I put them in that silver category because a lot of people still think of them as silver companies. And more importantly, when silver really begins to take off, people go to their broker and say, I want a silver mining company. The broker says, oh, let's buy Pan American. That's a good silver company. That's the largest, you know, US silver producer there is. The truth is, there's very, very few primary silver mines around the world other than Mexico, Bolivia, and Russia. and we know we can't go to Russia, and most people don't want to go to Bolivia. So there aren't a lot of, no offense to any Bolivians. So there's very few primary silver mines around the world. And if you look at the global production of silver, whereas 40 years ago, about 70% came from primary silver mines, today, less than 25% comes from primary silver mines. And that incidentally has a very, very significant effect on production, because silver production does not respond to changes in the silver price the way, say, gold production or copper production changes to changes in the price. Changes slowly, but it still changes. But if you're a tin miner in Bolivia or a lead zinc producer in Peru, you know, the price of silver, and you've got a byproduct silver of 14%, the price of silver can go up, but you don't increase your production of zinc because the price of silver went up. And so the silver production, on the upside and the downside, incidentally, does not adjust to changes in the price of silver. So yeah, so we have that high allocation to silver.
Yeah, and so the junior producers make up, what I remember on the spec sheet, it said 8%. So are the juniors just too risky, and that's why you keep a lower portfolio allocation, or is there something else there?
Yeah, what you're looking at is what we call our allocation sheet, which is, it's not really a wish of where we would like to be, it's where we actually are. And the truth is, I'm just not seeing an awful lot of those junior producers that I think are really attractive right now. Remember, one thing about junior producer can cover a lot of things. It can cover a B2 gold, which has, you know, 5 mines in 5 different jurisdictions, or and as a major producer, you know, produces a lot of gold, or it can include, you know, the 100,000 ounce single mine producer. And when you're looking at a smaller mine, there's an old saying that anything that can go wrong with a big mine can also go wrong with a small mine. And if you're a single producer at a small mine, you just don't have the cushion and flexibility when something goes wrong, but a major miner does. If you look at Barrick or Agnico, you know, every quarter, some mines are doing better than others, and some mines better than their history, and some mines have problems. That happens every single quarter. And if you're a Barrick and you have a problem with one mine, it doesn't really affect the overall company. It certainly doesn't put the overall company at risk the way it does for a single mine, a small single mine producer.
Yeah. So I'm interested in navigating over to uranium for a moment. When reviewing the spec sheet, I did notice that you were invested in the Sprott Physical Uranium Trust. There's a lot of the viewers who are paying attention that have been very heavily invested in the uranium bull market over the last few years. How do you view the uranium miners versus the uranium metal itself? Are you seeing the uranium metal, because of the supply demand situation, as more of a sure thing than
that's absolutely. No, I'm a very strong bull on uranium in the longer term. In the shorter term, I think it's had too much of a run up in too short a period. Doesn't mean I think it's going to correct. It just means it is vulnerable to a correction. And there's a big distinction, and people need to understand that. As an investor, you're not placing bets on what you think is going to happen. You're looking at what the risk and reward is. So there's a risk of a correction after such a big run up. I have to say that we got out of most of our uranium far too early. So I'm not trying to in any way pat myself on the back here. And I'll also say that I don't pretend to be a uranium expert, you know, the way someone like Lobo Tigre, who follows it very, very closely, is. But I think if you look at the uranium, I mean, if you look at the nuclear industry, nuclear is the cleanest, the cheapest, and the safest, despite what people think, form of reliable energy. Because, you know, there's some reliable. So if you look at those four factors, uranium is far and away the best form of energy. And so when you have a nuclear power plant that costs maybe $30 billion to put into production, to build, once you have spent $30 billion of borrowed money building it, you don't really care whether your uranium is 50 cents or $1.50 or $2.50. You're going to buy it. You're going to buy it at that point, because the cost of repaying your capex is a far greater expense than the current price of uranium. And so what that means is that as we see, and as we will see, if the world has any sense, as we see a nuclear renaissance around the world, over the next decade, 2 decades, the price of uranium is going to go up significantly. You know, in the nearer term, we've owned some of the uranium stocks. I think there's a tendency among some people to say, oh, well, this one hasn't moved yet, let me buy that. And there's normally a reason that the thing you're looking at in a bull market that we've just had, if it hasn't moved, there's a reason it hasn't moved. And it might actually be because they're never going to produce any uranium. And you just want to keep away, in my view. So for me, particularly now, after the big run up in prices, I would stick with the physical. If we get a bit of a correction, I would go into the majors like Cameco, but I would be very reluctant to go too far down the food chain, frankly.
Yeah. I appreciate your viewpoints on uranium. So before we wrap up here and I ask Adrian the final question, I want to remind everyone that we have a Substack. It's metalsandminers.substack.com. Head on over there. It's a free subscription. We have lots of free content going up every single week on the economy, on the consumer, metals, miners, and some other things. It's all digital. It's all in one place, all to be top of mind. And you can go back and refer to it and kind of make sense of what's going on here. There's also premium content there. We call it the Nugget Notes. It's a summary recap of our discussions. You'll find the one from with Adrian there. There's some premium interview content that's there. We have a critical report library and some other things. If you've enjoyed the conversation with Adrian as much as I have, would you please let him know by hitting the like button and the subscribe button and the bell icon button and leaving a comment below. All right. Adrian, in wrapping up our discussion,
and let me just say, if any of your subscribers look at your content and they can understand what's going on, could they please explain it to me?
All right. Well, I so appreciate you coming on and sharing your viewpoints and your analysis, because we think the world of you, and we think that we think you have an idea of what's happening here. So I have a 2-part question for you. In today's investing world, with our retirements, our nest eggs, it seems like we can no longer have those nest eggs in that traditional 60-40 portfolio. 60% spread across 5 mutual funds, the growth, the international, et cetera, and 40% in bonds in a set it and forget it type environment. It seems like we need a more active management style, and that we also critically need to minimize downside risk. It seems like after 40 years of a certain paradigm way of investing, it seems like it's changed. Can you speak into what you believe the right portfolio mix is for managing our nest eggs today? And secondarily, what haven't we spoke about on today's call here that you want the viewers to know or consider for 2024?
Yeah, okay. the first thing, obviously, the answer to that question will depend. It'll be different for every viewer. It'll be different depending on their own circumstances, their age, their net worth, their obligations, to children and grandchildren, and whether they're still earning money and so on and so forth, as well as their risk tolerance, their tolerance for risk, which, if I may, is a very, very important thing that people sometimes overlook. A traditional financial plan, or planner, you look at, as I say, your income, your net worth, do you own the house, what's the mortgage, are the kids going to college, and blah, 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 blah. And it spits something out. But what it doesn't do is answer the question as to whether that individual has a tolerance for risk. And when we say risk, what we often mean is volatility, which is something completely different. Mm-hmm. Volatility and risk are two different concepts. So, something that goes from $1 to $10, but goes to 50 cents in the meantime, is pretty volatile, but it's not risky. Something that goes from $1 to $0 or even $1 to 50 cents is risky. So people need to really examine how comfortable are they with volatility, because some people are and some people plain aren't. And if you have a low tolerance for volatility and for risk, you need to really, really minimize the amount of money that you have in areas where high volatility or risk, such as gold mining, is a possibility or is important. So with that sort of disclosure, or whatever you want to say, yeah, I mean, first of all, I would put 0 in long-term bonds. Bonds move in long-term cycles. You mentioned 40-year paradigm or something, but remember, bonds hit their low back in 1980 when Paul Volcker was Fed chairman, and they've basically been in a bull market until last year. 40-year bull market. And if you look at the bull market. And if you look at the bear market before that, that was basically 35 to 40 years. Bonds tend to move in very, very long cycles. We don't have time to go into why that is, but I think, we've entered a new cycle, a new turn, and it's quite likely we'll see a 30-year bear market in bonds going ahead. And so what we're getting right now, as I said, less than 5% on a 30-year treasury just is not rewarding you for that. So I would have 0 in long-term bonds right now. Right now, I mean, we have quite a bit, especially for more conservative clients, we have quite a bit right now in short-term treasuries. And I don't think there's any need to go more than 6 months. Most of ours is 1 month, 2 months, and 3 months. And it's a way of holding cash. It's not a great investment, but it's a way of holding cash and a relatively safe way of holding cash. I think you need to be very cautious of what are called the broad stock market in developed economies, not just US, but other, G7 countries, where the valuations are high. And again, when one says the valuations are high, you're not making a prediction about what's going to happen. You're looking at the risk and probability of something happening. So when valuations are high, yes, we all know valuations can stay high for a long period of time, right, but the risk is there of a decline. That's the important thing. So we would have right now, this is high, but for a lot of our, not even high risk clients, but mid-risk and higher risk clients, we have as much as 25% in gold assets right now. And we have another 10% on top of that in other gold and silver, and then another 10% on top of that in other resources. A lot of people say that's very high, but that's where I think the best values are and the best risk reward for the next year or two. We're very cautious of the developed markets. There's always exceptions, of course. We're looking for the smaller markets, not necessarily, tiny emerging markets, but smaller markets. for value, and that might be Singapore, for example, very solid, and some very great, some very solid companies there. And then we're also looking at a few, somewhat more risky markets. But so that's basically where we're invested right now.
Okay. And is there something you want the viewers to know that we haven't discussed today for 2024 that they should be thinking about?
Yeah. Well, I guess, yeah, I guess it's, as was it Wayne Gretzky,
Skate to the puck.
It's going to be.
Yeah.
Things always, I think it's sort of advice, if you like. Things always take longer to play out than you think they're going to.
Yeah.
And so the important thing is that if you're positioned, of course, you have to re-examine your premises all the time. And I don't mean that you should be stubborn, certainly not if facts and circumstances change. But if you re-examine your premises and you are convinced that you are in the right position, you really need to have patience to hold on, because even in this fast-moving world, things always take longer to come to fruition than you expect them to. But the corollary of that, frankly, as Rick Roll says, just because it's inevitable doesn't mean it's imminent. Right. He probably said that on your interview. I wouldn't be surprised. But it's a good point. But the corollary of that is that when something is inevitable, whether it's the collapse of the dollar or gold moving up, when something is inevitable, when it starts to develop, then it can often move a lot faster than you think. So you just need a bit of patience to hold on.
That's some great wisdom. It really is. I appreciate that. Adrian, thank you so much for being so generous with your time and your analysis and your ideas, and for coming on to Metals and Miners. It's been wonderful to spend this time with you. Yeah. Would you tell everyone where they could find your work and how they can connect with you?
Yeah. The best place to go is our website, www.adrianday.com. And then you can swipe left for the newsletter and swipe right for the money management.
Wonderful. All right, Adrian, thank you so much. It's been wonderful.
Thank you very much, and good day to everyone.